Hi everyone, it's Sean from Pulse Markets here. Today we're speaking with the Lowell Resources Trust, one of the fund managers, John Forwood. As you know, we've been very supportive of the Lowell over the years because of their performance and the space that they're in. There's a couple of things happening in the markets at the moment. We thought it'd be prudent to get advice or to get some, ideas from John, who's navigated these markets very successfully over the last 10 years. And what I'm going to do is just ask some limited questions, just briefly, because he doesn't have much time today, and just go through how things are going. So, hi, John, how are you?
Sean, great to be here. Thanks for the opportunity to have a quick chat, and also thanks for your support over a number of years. So, great to be talking again.
Thanks, John. I'll get right into it. Obviously, the markets had a bit of a pullback, then a bit of a push up, but there's many sectors to the markets, and the Well focuses on the resource sector. Can you just give us a bit of a rundown of what's happened to resource equities recently, and what have been those main drivers, please?
Yeah, well, look, like a lot of the market has been pretty volatile. We had a really good run from pre-COVID through to April this year, when a lot of the markets peaked, and then the junior resources market's been a bit crunched, down 34% to mid-July, but it has then bounced back. So, and we've seen similar performance from some of the key commodities underlying that. Oil and copper. People might remember that oil went negative back in I think it was April 2020 at the start of COVID. Recently topped out at over $110 a barrel, and it's pulled back a little bit since then. Copper similarly has had a bit of a pullback in the last couple of months, and gold also a bit of a pullback. But there's a couple of commodities that are still at record highs, and there's fundamental reasons for that. Gas, because of the situation in Russia and the Ukraine, natural gas is hitting exceptional prices, even here in Australia. And then lithium, also another energy-related commodity, is still at record levels. So, I think the short-term drivers for that, the pullback, I think a stronger US dollar is generally, for US dollar denominated commodities, generally is makes the commodities look a bit cheaper. And we've had a stronger US dollar, of course, because of the rising interest rates in the US. I think China's, it's like a driver of a car with one foot on the brake and one foot on the accelerator. They've been locking down parts of the country, but at the same time announcing a huge stimulus. They announced $1 trillion US dollars of stimulus for infrastructure spending. And then we've had the situation in Ukraine with sanctions on Russian oil, pushing the oil price to elevated levels.
Okay, that's very enlightening. John, with all that in mind, what are the long-term drivers the Lowell Resource Funds Management sees impacting the resource sector? I might also note that there was something in the fin this morning when I was flying down to Melbourne that BHP had put a takeover bid for Oz Minerals. So they're obviously very bullish on commodities. What do you think the major impacts are?
Yeah, look, I think there's probably three long-term fundamental drivers that top of mind. The first is, and related to that bid for Oz Minerals, which is a major mid to senior tier copper producer here in Australia, is the demand for copper, and that's being driven by the decarbonisation thematic. You don't decarbonise without electricity, and you don't have electricity without copper. So copper demand is forecast to double by 2035, and even in the most optimistic supply scenarios, there's just not enough copper to meet that demand. So that's one. Another long-term or longer-term trend is, call it anti or de-globalization. Examples are, the US trying to decrease its reliance on Russia for things like strategic minerals. US trying to decrease its reliance on China for strategic minerals. and Germany trying to decrease its reliance on Russia for energy, in particular gas. So that onshoring of supply will certainly drive up prices as it progresses, prices for commodities. And then the big one of the three is the lack of investment. The capital being invested by companies that supply raw materials has really dwindled. And a really good example of that is in the oil and gas sector, where you're seeing the big majors, and we know the reasons for this, but they're doing share buybacks, they're paying special dividends, they're investing in wind farms. They're almost doing anything but investing in their own businesses, and those chickens are coming home to roost. So we've seen industrial metal stocks on the LME and the Shanghai Futures Exchange hit fresh multi-year lows just last week, and we expect that to be a chronic, ongoing situation which will only worsen over time and drive prices up.
So even with the lack of investment, and there's not going to be enough metals from what you're saying, if we hit into a recession, will prices still rally?
Yeah, look, that's a really good question that we discuss a lot, and there is quite a lot of precedent showing that commodities actually do well through recessions. So in 1973, 1980, and 1990 recessions, commodity prices rose like they have done recently, ahead of the recession, and then they fell as the recession began, as we've seen here in 2022. But then commodities rallied through those recessions to actually come out on average 20% above the pre-existing level. So commodities and hard assets can do well in recession.
Okay, that's excellent. One that we're very interested in, having been one of the joint lead managers with Southern Cross Gold. How does gold perform in a recession? I know your portfolio is very big in gold. You've done very well out of that too. What about gold?
Yeah, look, similarly, gold in the 7 main recessions we've had in the past 50 years, gold has risen in all but one of those recessions, and averaging around a 15% rise through those recessions. And I think it was 1973 might have been where gold rose over 80% during the recession. So, and beyond that, look, it looks like we could be in a period of stagflation, where we've got high inflation and low growth, and gold is the commodity or the asset class which performs the best historically during stagflation. So yeah, look, we're well positioned. We've got around 50% of the Lowell Resources portfolio exposed to the gold price, and gold has been hit. It got down to below $1,700 US an ounce, but it's starting to bounce back, and it's, I think, today trading around $1,770 US an ounce.
Okay, great. One thing I have noticed is that the Well is conducting a rights issue at the moment, and obviously the market, from what you're saying, is the beginning of a potentially cycle where commodities can go much higher. Do you see the opportunity now for your fund to grow and to take more funds in and move forward with the markets, do you?
Yeah, absolutely. The rights issue is to allow us to access some more cash to deploy into the market. We have been making the most of the opportunities represented by this pullback, because a number of sectors in the commodity space look extremely good value, and some of our existing holdings we'd love to be able to top up even more at the moment, because of the really attractive entry pricing that they're representing. That's from gold right through to copper and other base metals, energy metals, and oil and gas as well. So look, there's some fantastic opportunities out there which we see we could deploy some more cash into.
That's excellent. I think I'll be advising my investors to certainly take advantage of those rights, and I'll certainly look at trying to get some myself to put in there.
Great.
Lastly, because I know you're quite busy, the US government, and I think the Chinese government too, announced more than $1 trillion in anti-inflation spending package. And I can't get my head around that, offering more money, printing more money to tackle inflation. I thought you'd do the opposite. But with that in mind, how might that affect the commodities? All this extra money again coming into the markets. Is that also why you're looking at doing the deal now?
Yeah, look, we've seen, in the past few months, the Chinese government announced that $1 trillion of infrastructure spending, and that will definitely stimulate demand for metals and commodities. But just recently, we've heard that the US package, which is basically $1 trillion Australian dollars anti-inflation, has passed the lower house in the US. So it looks like that legislation will go through, and that'll have two effects. A, there'll be more money in the system, which will drive inflation further, even though it's called anti-inflation bill. And B, the specific elements of the package, which a number of which are for the transition to renewable energy, that will drive demand for things like copper, lithium, all the energy metals specifically. So look, on both fronts, we see that as positive news for the commodities sector.
That's excellent. I think with the timing of all this, with your rights issue, where the stock's being offered to investors with the attaching option, I think it's a very, very attractive offer that you've put out to people. And as I said, we'll certainly be supporting it and recommending it. And again, John, we really do appreciate your insights. That performance that you've done speaks for itself for 10 years. I know you've been progressing a lot longer than that, but the last 10 years, you're almost number one. So congratulations on that again, and good luck with the rights issue and picking the market like you've been doing for so long.
Thanks, Sean. Great to chat. And once again, thanks for the opportunity and for your support.
Look forward to seeing you soon, John. Take care.
Cheers, Sean. Bye.